Chapter 11, Lending Practices. There are a couple of terms we need to be familiar with before we get into Chapter 11. The principal amount on a loan is the balance owed. It's also known as the amount outstanding. The interest is the rent on the borrowed money. And the maturity is the life of the loan. It begins with origination and it ends with the loan's maturity. Here are some different types of loans. The term loan is a loan that requires only interest payments until the full amount or the principal amount is due. This is also known as a straight loan. An amortized loan has equal payments for the entire life of the loan. Those payments include parts that belong to repayment of the principal as well as payment of the interest charged by the lender. A budget mortgage is one where not only does the lender collect monthly principal and interest payments, but the lender also collects 1/12 of the annual property taxes and 1/12 of the hazard insurance premium on the mortgage property. This ensures that the collateral for the lender is protected from a property tax lien if the taxes are not paid, and it also protects against financial loss associated with a hazard or peril. A balloon loan is any loan that has a final payment larger than any of the previous payments. So, for instance, a term loan that requires only the interest be paid until the very last payment, when not only interest but the entire principal amount is due. A term loan is also a balloon loan. A partially amortized loan, its payments help to pay the interest, some of the interest, periodically, as well as part of the principal reduction. However, it is not fully amortized in that it needs a larger payment at maturity to fully pay off the debt. Here's a graphic that illustrates the difference between a term loan and a fully amortized loan. I do have to note that the payments here are made on an annual basis. In real life, mortgages are paid monthly. The note is paid monthly. So onward, with a term loan, we've got a $1,000 loan for each of these loans, whether it's a term loan or an amortized loan. A $1,000 loan over a 6-year maturity, and they both carry a 9% interest rate. With a term loan, only the interest is paid annually. So 9% of $1,000 is $90. So $90 is paid every year, years 1 through 6. However, in year 6, the borrower has to come up with this huge repayment of the principal, the $1,000. So that final payment is $1,090. The amortized loan, on the other hand, all of the payments are equal. For a $1,000 loan over 6 years with annual payments and 9% interest, the payment each year is $222.92. So the payments are equal each and every year, and after the last payment is made, there is zero due on the loan. As we can see, there's a substantial difference between the total payments between the term and the amortized. With an amortized loan with these equal payments, One thing to note is that the principal amount, while the payments are equal each year, part of each payment goes to reducing the principal and some goes to paying the interest on the loan. As we see, the division between the principal and the interest on this 6-year $1,000 loan at 9% interest, the principal part of each equivalent payment tends to grow as we get closer and closer to maturity, whereas the interest portion of each equivalent payment reduces as time goes on. So, to recap, when it comes to loan amortization, paying a mortgage may include the following factors. With a budget mortgage, the loan payments made to the lender include parts for principal repayment, the interest on the borrowed money, property taxes, and insurance. This is also known as PITI, P-I-T-I. Some loans are balloon loans in that a balloon loan is one in which its final payment is much larger than any of the previous payments. With a partially amortized loan, the payments, part of the payments go to the reduction of principal and part of each payment goes to paying the interest to the lender. However, with a partially amortized loan, there is still the need for a balloon payment at the end. There's also the idea of an earlier payoff. This reduces the maturity on a loan. Payments are increased, however, over the full term, less interest is paid and there is faster equity buildup. And this can occur in any of these loans. With a 15-year loan, most mortgage loans, their maturity is over a 30-year period. Well, with a 15-year loan, the loan payments will be larger. However, the payoff will be faster, so less interest will be paid overall and a quicker equity buildup. We can also accomplish an earlier payoff by what's called bi-weekly payments, where a borrower would take their monthly note, divide it in half, and pay that amount every 2 weeks. Again, we have an earlier payoff, a faster equity buildup, and overall less interest is paid. And then what about existing loans? Well, certainly any time a borrower makes a payment to his lender that's larger than what is required by the lender, they will end up paying off their loan faster. For instance, if a monthly note might be $550 a month, if the borrower decides to send in $600 a month, certainly that will lead to an earlier payoff, faster equity buildup, and reducing the maturity. Here's a table in your textbook about how to find a monthly payment over what is the monthly payment per $1,000 of a loan. So what you need to do is to index this table by the maturity of the loan and the interest rate charged by the lender. Once you index the table, you will find a factor. You will multiply that factor times for every $1,000 that is borrowed. That will then lead you to your monthly note. The next payment the next table in Chapter 11 has to do with finding the balance owed. What is the amount left to pay on a loan? Well, these tables are written exclusively for each interest rate. So on the left, you'll see a loan with an interest rate of 9.5%. On the right, 11.5%. So we index those tables by what was the original maturity of the loan and what is the current age of the loan. So once you index and you find a factor, you multiply that times the number of, or how many thousands of dollars were borrowed. That will lead you to what is the amount left to pay, the balance owed on the loan. The loan to value ratio is a common term used in lending. It's the relationship between the amount of money a lender is willing to loan and the lender's estimate of the value of the property that will serve as their security or collateral. It's often abbreviated as LTV or LTV ratio. So here's an example. If the market value of a property is $100,000, and if the lender is willing to lend $80,000 on that transaction, the loan to value ratio is 80%. Some more loan terminology includes equity. Equity is the value difference between the property's value and the outstanding debt on the property. There's a couple of different ways that a borrower can increase their equity. Well, one is by reducing the outstanding debt, in other words, making payments on the loan. Another way to increase an owner's equity is when the property value increases. Loan points represent 1% of a loan amount. Points are often charged for an origination fee. This is the fee the lender charges for making a loan. In other words, these are the expenses the lender incurs when processing a mortgage loan. So they're going to charge an upfront origination fee, and it may be expressed as points. 1 point equals 1% of the loan amount. Loan points can also be expressed as discount points. These discount points are charged by lenders, and it increases the lender's return on their loan. So 1 point would increase the lender's yield by 1/8 of 1%. Points are usually paid for by the borrower. VA and FHA comparisons, let's define what a conventional loan is. A conventional loan is a loan that is not insured by the FHA or guaranteed by the VA. All right, so let's now turn our attention to FHA and VA loans. For the most part, private lenders do the lending for these loans. So first, FHA loans are from the Federal Housing Administration. The FHA was established in response to the Depression of the 1930s. FHA does not make loans. Private lenders do the lending. What FHA does is that they insure loans. They insure lenders against the losses associated with loans when a borrower defaults. For this insurance, FHA charges an upfront mortgage insurance premium. It's an annual premium as well as a one-time premium. Both are paid by the borrower. Anyone can qualify for an FHA loan. There is no income limit. But there are limits on the value of the properties which can be financed with an FHA loan. The rate between the borrower and the lender is negotiable. Points can be charged with an FHA loan, and the seller. With an FHA loan, it's the seller that's going to pay all or part of the points. What's very enticing about an FHA loan is that it requires the borrower to only put 3.5% down. So that results in a 96.5% loan-to-value ratio. With conventional mortgages, the down payment requirement is much higher, closer to 20%. So again, the FHA does not make loans. They insure loans. They insure lenders against the losses associated when a borrower defaults. So if the borrower defaults on an FHA loan, the premiums that are paid by the borrowers are used to reimburse the lender. The FHA operates this program at no cost to taxpayers. VA loans, however, are administered, or this program is administered by the Department of Veterans Affairs. And what this program does is that it guarantees loans. It's a substitute for protection provided a lender by a down payment. First of all, a VA loan, again, most of the time is going to be provided by a private lender. To qualify for a VA loan, of course, the borrower has to be a veteran, and they receive a certain certificate which qualifies them. Then the property is appraised by someone within the VA, and they receive what's called a cost of reasonable value, a certificate of reasonable value. So the VA guarantees loans, and how much is guaranteed is on a sliding scale. And a funding fee is charged for this type of guarantee, and it's one time only. Of course, only veterans are eligible for this program. They must receive what's called a certificate of eligibility. The rate between the borrower and the lender is negotiable. Points can be charged on a VA loan, and there is no down payment requirement, so that leads to a 100% loan-to-value ratio. The VA will loan only if the veteran cannot find a lender on his own. In the event of default and foreclosure, the borrower is still responsible for making good on losses suffered by the VA, or suffered by the lender, I should say. Some similarities between the VA and the FHA programs in that the property has to be owner occupied. It could be between 1 and 4 family dwellings. Refinancing is allowed, as is assumption with approval only. Some websites for the VA program, the FHA program, and some general information about conventional loans. So as we mentioned earlier, that a conventional loan is a real estate loan not insured by the FHA or guaranteed by the VA or generally any government entity. Therefore, mortgage insurance was formed to insure home mortgage loans. And there are some private mortgage insurance firms out there for conventional loans. For conventional loans that have private mortgage insurance, sometimes a lender may require this, then a smaller down payment would be required when private mortgage insurance is purchased. It's going to insure the top 20 to 25% of the loan, and when the loan is partially repaid, the premiums are then canceled. And of course, we have the FHA insurance program and the VA loan guarantee, and it insures lenders against loss. The Rural Housing Services Administration is a federal agency under the U.S. Department of Agriculture. So this department also came into existence in the 1930s as a result of the Great Depression, and it offers programs to help purchase or operate. Here's some of our key terms associated with Chapter 11. Any questions? Shoot me an email.